Spooking global markets. We've got Robert Parker joining in from Credit Suisse to answer that question. Mr. Parker, thanks so much for taking this call. What's your sense? Why this sudden wave of panic pretty much across the board?
Well, we have a raft of negative factors which have hit markets really since last Wednesday and Thursday. And I think just to list those factors which have all come together. First of all, as you mentioned, we have had very weak Chinese export data. That's down 17% year on year. That, in turn, has had a negative impact on commodity markets. So those markets, like, for example, the FTSE, where there is a heavy component of commodity companies, have seen major declines. Linked into that, we had what can only be called a sort of very fractious OPEC meeting at the end of last week, where there was no agreement on cutbacks in supply production. And consequently, we have seen, as you mentioned, a significant fall in oil prices since last Friday, with West Texas Intermediate trading, at 37 as we talk. And then I think, in addition, one has to highlight the disappointment with the announcement last Thursday from the European Central Bank over its quantitative easing program, where there were very strong expectations that the European Central Bank would increase the monthly amount of QE from 60 billion a month. Mr. Draghi didn't announce that, and we saw a negative reaction to European markets late last week, and that's had followed through this week. I think linked into that, obviously, the recovery in the euro back to around 109 has also had a negative impact on European equities. I think also one has to emphasize the very high probability that the Fed does raise interest rates next week to 50 basis points. So we've got this confluence of negative factors, and I wish I could find some positive factors to give you, but I'm struggling to find any at the moment.
Well, Mr. Parker, you mentioned the Fed. Is it that what we're witnessing right now is the worst of the selling, so the market is pretty much absolutely prepared for a rate hike? Do you think we'll get a rate hike? How bad or how volatile can the reaction be? Or is the worst of it taking place right now as we speak?
Yeah, I think the interesting question is what happens if the Fed does not raise rates next week? And I think, in fact, then the market reaction would be negative, because I think investors would immediately take the line of, well, perhaps the Fed knows something we don't know. And I think you would see a down rating in investor expectations about the outlook for the U.S. economy. So I think the Fed's now got itself into a situation where, frankly, to maintain its credibility, I think it has to raise interest rates. And, one positive, while we're talking about all these negatives, one positive, of course, is that we did have good labor market data out of the United States last week. And that would certainly support the Fed raising rates to 50 basis points from 25 basis points. I think the interesting question is what happens thereafter. And, I stick to my view that the Fed will move very slowly indeed. And I very much doubt that we'll get 25 basis points a quarter in 2016. By the end of 2016, I think the Fed funds rate may be up to perhaps 1%. So I think what we will see as we go into January and February after this quite nasty year-end selling is that we'll see markets start to calm down, albeit at levels slightly below where we are today. And I think part of the reasons for the markets to calm down in early 2016 is the expectation that the Fed will move slowly after the first rate increase next week.
So, Mr. Parker, quick sense on what's also happening in the commodity universe. I mean, you mentioned the Chinese data, and I completely understand that. But is the worst of this oil slide over? Are you expecting more? And then also overall, if this is a bit of a correction, is it one in which you should buy, or is it one that you should actually sit out of?
I think there are two answers to that question. The first answer is we will get a base in the oil price when the daily surplus, which only 3 months ago was 2 million barrels a day, when that daily surplus of supply over demand is eradicated. Now, with oil prices at current levels, obviously, the vast majority of American shale production is uneconomic, as is a lot of high-cost oil production in areas like Alaska and the North Sea. So I think we are going to see a crunch in cutbacks in supply, and that's why I think that oil prices probably stabilize close to levels where we are at the moment. So, if one looks at West Texas Intermediate, I would say 35 is the base. If you look at Brent, I would say, just under $40 per barrel is the base. But the second answer to your question is, should you be buying oil stocks? And, the answer to that is no. And that's because earnings from the energy sector, I think, are going to be depressed for quite some time. And they're only going to improve because of cost cutting and cutback in production. So oil companies, I think, remain an unattractive area to invest in.
Finally, so last question to you. We keep hearing at a lot of foreign investor forums that India is still, perhaps one of the better markets in the emerging market. But nobody's putting in any money. In fact, money is flowing out. We're seeing FII dollars go out on a daily basis. What impact do you think this will have on fund flows into a market like India, all of this risk aversion?
Well, I think a number of factors. The first factor is that fund flows ahead of year-end, I think, are moving back to their home markets. So you're seeing, investors de-risking their portfolios for year-end. And, obviously that is not good news for India, but likewise it is not good news for most other emerging markets. And, I think a general statement is that investors are very underweight emerging markets at the moment and are likely to go even more underweight over the next few weeks. And I think actually that could well reverse in 2016 as investors rebalance their portfolios more positively towards emerging markets. And certainly in the case of India, yes, the market has been expensive, and that's been a problem for most of this year on the market. But India has the big advantage of inflation is low, interest rates have come down. India is a huge beneficiary from low oil prices and low commodity prices. And although it's very difficult to be positive on the market in the short term, the next week or two, I would say that as we go into January, you'll start to see those foreign capital flows start to stabilize.
All right. Pleasure talking to you. Thank you so much for taking out the time to be with us on the show today.